We've taken our recent webinar on stock compensation planning and we've produced 5 topical segments. This following segment on the income taxation of stock awards is of particular interest. I hope you'll enjoy it. Thank you.
So I'm Mona Goudet. I am a partner in the employee benefits and executive compensation practice at Faegre Drinker. I've been a partner for 10 years, and I've been practicing in this space for over 20 years. So in connection, I think we had a good presentation on financial planning, estate planning, and in this connection, I think it would be a good idea. And what I'm going to do is give you basics of the tax implications of the different types of stock awards that you may have gotten from your employer. So my understanding is most of the audience are executives at publicly held companies. In that situation, what you probably have is what's called an omnibus plan that is set up by your employer. And the omnibus equity plan, if you don't have it, you can find it online. If you go to sec.gov, go to the Form 10K filed by your company, scroll down to the exhibit, and it will be listed there, and you should be able to click in and get a copy of your omnibus plan. It's a good idea to know what's in the plan. So one of the things that Russell mentioned was, does your company allow you to assign or gift your options? Well, the first place to look is your omnibus plan. You go to the miscellaneous section in the omnibus plan, and that will tell you whether you can or cannot transfer your options or other equity awards. So you should have some familiarity with that plan document. Now, an omnibus plan would typically provide for different kinds of equity awards. So you will have stock options, stock appreciation rights, restricted stock units, performance stock units. And the tax treatment of all these awards is a little bit different. So it might be useful just to walk through the tax treatment so that when you're talking to Jay or Dan, or you're talking to Russell, you have some idea of what the tax implications are. You have a starting point. So you may have stock options that your employer has granted to you. So basically a stock option, as you know, is a right to purchase stock in the future of the company. The options may be of 2 kinds: incentive stock options and non-qualified stock options. In either case, the option is not taxed on grant or on vesting. The tax treatment then differs on exercise. So if you have what is called a non-qualified stock option, then the spread is taxed as ordinary income upon exercise. And then any run-up in value after exercise is taxed as capital gains upon disposition. So how do you know if you have a non-qualified option or an incentive stock option? You would just look at your option grant agreement, and it will say whether the option is an incentive stock option or a non-qualified stock option. An incentive stock option is a special kind of option that gives you a better tax result. And basically, if you have an incentive stock option, there is no tax upon exercise, and any run-up in value from the grant date to the disposition date is taxed as capital gain. So because capital gains rates are typically lower than ordinary income tax rates, you end up getting a better tax result with incentive stock options. Jay mentioned some of the things that you have to be careful with when you have options. So one of the things he mentioned was, hey, make sure you exercise your option before the term expires. So typically options have a 10-year term. I know some of my clients have 7-year terms on their options. So that's the option term. But the other thing you want to be careful about is, let's say you were to leave the company, then most options would only have a 3-month exercise period after termination. Or if you become disabled, they might have a 1-year period of exercise. So you want to be careful about, in addition to the term of the option, to know what is exercise period of your option so that you don't inadvertently not exercise the option and then forfeit it because you've not exercised it. They also mentioned the holding period requirement, and where that comes into play is with incentive stock options. So let's say you have exercised your option. It's an incentive stock option, you have exercised it, and you have shares. Now, the holding period requirements apply to those shares, and to get the preferable incentive stock option tax treatment, you have to hold it for 2 years after grant or 1 year after exercise. So if you have an incentive stock option, make sure you're aware of the holding period requirement. The other type of award that we have is stock appreciation right. So basically, this award gives you the right to get the appreciation on that on the stock from the grant date, and it may be settled in cash or in stock. And the spread is taxed as ordinary income upon exercise. And of course, if you have cash, then after exercise, you don't have this opportunity to get capital gains treatment. You just get the cash. The other type of award that may be provided for in your omnibus plan is called a restricted stock grant or a performance stock grant. And basically what it is that the company actually gives you stock, but the stock is subject to transfer restrictions. And the transfer restrictions could get waived if you stick around with the company for a period of time, maybe 3 years. And then in that case, it's called a restricted stock. Or the transfer restrictions may be waived if certain performance targets are met. Maybe the company's EPS has to reach a certain threshold. There might be some other performance requirement tacked onto your award. So you want to, once those requirements are met, then the stock becomes taxable to you. However, you should know that when you get a restricted stock or performance stock award, you have the opportunity to make what's called an 83B election. And again, whether or not you should make an 83B election, you should reach out to your financial planning advisor. And the way an 83B election works is you get to lock in the tax on the value of the stock at grant. The election has to be made timely within 30 days of grant. But you want to be careful whether you make or don't make the election, is because once you make the election, it's not reversible. So let's say you get a restricted stock grant which says, okay, if you stick around for 3 years, then you have the ability to transfer the stock. And at grant, you make an 83B election, you pay the taxes on the value of the stock at grant. And for whatever reason, you leave the company after 2 years and you forfeit that restricted stock grant because you have left the company. In that case, there is no going back and undoing that 83B election and recouping the tax. So you want to be careful when you make an 83B election that that you are probably going to stick around for the vesting period. The other type of grant that is provided for typically in an omnibus plan is a restricted stock unit award, or what's called a performance stock unit award. And the difference between a restricted stock unit and a restricted stock award is that a restricted stock unit is just a piece of paper that you get at grant, as opposed to restricted stock where you actually get the shares at grant. And the way it works is the restricted stock unit is taxed when it is paid. Although typically the way they are structured is they're paid upon vesting. So many times people will, as shortcuts say, hey, you will be taxed upon vesting on this restricted stock unit award. You want to be careful. This type of award is subject to Section 409A rules on deferred compensation, and typically it's structured under the short-term deferral exception. So if you are thinking, or if somebody suggests to you about changing the time or form of payment of this restricted stock unit award, you want to be sure to talk to your tax advisor and say, hey, what implication does this have for me under 409A? And reason you want to know is that the 409A penalty falls on the executive and not on the company. So you want to be very careful to the extent the time or form of payment is changed. Okay, so you have, you're an executive with the company, you have this omnibus plan, you have some grants. What are the negotiation points? So with a publicly held company, typically, you have some limited negotiation ability, but you could ask for example, acceleration of vesting upon death, disability, etc. I just wanted to mention, okay, so the other negotiation point might be exercise period, and then change in control. What is the treatment of the award upon a change in control, and what, if anything, you can do with it? So these are points to talk with your financial planner. With that, what I will do is I will turn it back to Jay for the Q&As. And Jay, do you want to take it from here?
Yes, absolutely. Thank you, Mona. And sorry, I think you got cut a few minutes short because we were long-winded earlier. Let's jump into question and answers. We did get a couple of interesting questions, and Mona, I'll direct the first one to you. A question in regards to the negotiation in a publicly held firm. How much leeway do you have? And when you're between jobs, do you have more leeway negotiating for a new job in the same company, or if you leave your company going into a new company, what leeway might you have?
Absolutely. So basically, when you're going into a new job, obviously you have more negotiation ability. And what I tell my executive clients is, get yourself familiar with the company's plan. Go to sec.gov, download their plan. You will see, what the plan says, because you don't want to show up asking for something that is not provided under the plan. You're not going to get it, period. The other thing you want to do is look up the company's proxy. And again, that's called that's the form DEF-14A. It's on sec.gov. And that has a section on executive compensation. So make yourself familiar, get familiar with the company's compensation policy. So if the company's granting options to everyone, you're not going to get restricted stock, even though you might want to get restricted stock because it's a full value award. So you have more ability to negotiate when you're moving jobs, but if there are some boundaries, and you want to familiarize yourself with the boundaries. So, make sure you're aware of the company's plan, make sure you're aware of its, executive compensation policy, and then you can strategize about what it is that you want. If you're in the same job, you have limited ability, you're probably not going to get more than what the next level is making, but you should have some idea of what the next level is making. So then, you can strategize and ask for what
is that a reasonable question to direct to HR? What, like what at your level and at the next level, what the range of compensation, for stock compensation is?
You could, but HR typically will not give out that information. I think it's informal. You informally ask around and try to figure out what people are getting. At the same time, when you go to negotiate, you cannot, you have to negotiate in general terms and basically say, it is my understanding that the next level gets this or that, and that's where I would like to be.